हाँ बट आई थिंक वी कैन स्टार्ट।
स्टार्ट करते हैं।
हाँ स्टार्ट करते हैं, कौशल स्टार्ट करो।
So, hello, good evening, everyone. This is CA Kaushal Sharma. I am a okay. So, very good evening to everyone. This is CA Kaushal Sharma, qualified chartered accountant and CFA level 2 pass out. I would like to thank the chairman of NIRC, CA Abhinav Agarwal, and the program director, CA Gaurav Garg, who gave me opportunity to become a moderator in the today's webinar. And today we are going to discuss the key issue on international taxation. And as we know, we have very renowned and experienced faculty with us who is the good expertise in the international taxation. And he is the chartered accountant, qualified chartered accountant, and a CPA with over 30 years of experience in corporate taxation and accounting. And he worked extensively in the corporate taxations and compliance tax litigation and rendered advisory services in taxation as well. And his name is CA Saurabh Bhattacharya ji. So he is the today's faculty who will discuss the on the key issues on international taxation and make us understand about that. And we have CA Jimmy Mittal ji as well, who is the coordinator of the today's program. And we have CA Jagdish Singh ji as well, Nikasa chairman, and CA Navya Malhotra, secretary of NIRC of the ICAI, and CA Gaurav Agarwal, treasurer of NIRC of ICAI. So, in now I would like to invite uh, CA Gaurav Garg, who is the program director, to take the session ahead.
Thank you, Kaushal. A very warm welcome to all of you in this the first day of 3 days online bootcamp on the international tax. But before I speak, I would request Honorable Chairman of the Batinda branch, who is also the coordinator for the today's session, Jimmy Bhai, to share his words, for all the participants. Jimmy Bhai, over to you.
जी सर, जी सर, जी सर। सर, फर्स्ट ऑफ ऑल, गुड इवनिंग टू ऑल ऑफ यू एंड आवर रिस्पेक्टेड चेयरमैन अभिनव अग्रवाल जी, वाइस चेयरमैन है नहीं मेरे ख्याल से, शालिनी मैम ने ज्वाइन नहीं किया, सेक्रेटरी नव्या जी, ट्रेजरर सीए गौरव अग्रवाल जी, हमारा इमीडिएट पास चेयरमैन गौरव गर्ग जी, निकासा चेयरमैन सीए जगजीत सिंह जी एंड सीए कौशल जी, and our today's guest speakers and all my dear CA friends. Sir, first of all, very good evening to all of you. Sir, I think जो आपने ये सेमिनार वाला प्रोग्राम किया है, it is first kind of initiative. जो boot camp on this is a series of Gurukul series on the various seminars. The yesterday was the first seminar on the topic, I think, blockchain facility, and today topic is bootcamp on seminar on international taxation aspects. एंड मेरे को लग रहा है सर ये बहुत अच्छा इनिशिएटिव है, और ये सेमिनार है जो मतलब बहुत ज़्यादा वेबिनार है, इससे मेंबर्स को बड़ा बेनिफिट भी मिलेगा और नॉलेज भी सर काफ़ी अच्छा है। इंटरनेशनल टैक्सेशन जो आज का टॉपिक है, वो तो वैसे ही आजकल मतलब एनआरआईज बहुत है हमारे एरिया में, पंजाब में तो ज़्यादातर हैं, तो इट इज़ वेरी यूजफुल फॉर द मेंबर्स। और बाकी सर इसके बाद कल और है थर्ड डे का, मेरे को ध्यान में नहीं है, बट अदरवाइज ये जो एनआईआरसी की नई टीम है सर, इसका जो कोर्स ऑफ एक्शन है इस मंथ में, जो अभिनव भाई ने एक भेजा था अपने को प्रोग्राम, उसमें काफ़ी सेमिनार्स हैं लगातार, काफ़ी प्रोग्राम्स हैं, टूर भी लेके जा रहे हैं। तो आई थिंक इट इज़ अ वेरी गुड इनिशिएटिव ऑफ द टीम, और इसके साथ ही सर मैं थैंक्स कहूँगा। और हम हर टाइम आपके साथ ही हैं, और अभिनव भाई और गौरव अग्रवाल जी हमारे एक्स ऑफिशियो जो मेंबर हैं, सर सबको थैंक यू सर।
Thank you, Jimmy Bhai. Before we proceed, I would request other regional council members also to share their inputs within a minute, starting with Jagjeet Singh Jagji.
Thank you, Gaurav bhai. Gaurav Garg ji, हमारे immediate, the past chairman of NIRC, the present NIRC chairman Abhinav Agarwal ji, our secretary Navya Malhotra ji, and of course the treasurer Gaurav Agarwal ji, and Jimmy bhai, the chairman of Bathinda branch, today moderator of this program, Kaushal Sharma ji, and very learned, very knowledgeable person, intellectual person for this international topic, our first speaker, Saurabh Bhattacharya ji. So on behalf of all the NIRC member, the complete team, I welcome all the present those member in this webinar, the very first webinar in this Gurukul series, international topic. International, of course, taxation is the very important topic, and already we have the expert Gaurav Gargji with us, who is handling the international taxation matter. So will not take much time. So over to Gaurav Gargji for further proceeding because the members are waiting. Thank you, Gaurav bhai.
Thank you, Jagjit bhai. I think still members are joining, so we have still good couple of minutes to take inputs. Now to the treasurer NIRC, Gaurav Agrawal ji, please. आप म्यूट पे हैं गौरव.
म्यूट पे गौरव जी, म्यूट पे हैं.
Respected Chairman Abhinav Agarwal ji, Secretary Navya Malhotra ji, immediate past Chairman Gaurav Garg ji, Jagjit Singh ji, Nikasa Chairman, and our faculty for the day, Saurav Bhattacharya ji, and Jimmy Mittal ji, Chairman Bathinda branch, and the lovely moderator Kaushal Sharma ji. सबसे पहले सारी ऑडियंस को, आप सबको राम नवमी की पावन पर्व की ढेर सारी बधाइयां. भगवान राम की कृपा आप सब के ऊपर बनी रहे, और जैसे आज राम जी के ललाट पे सूर्य की किरणों से अभिषेक किया गया है, वैसे ही सूर्य की किरणों से आप सब ऊर्जामान रहें, जगमगाते रहें और चमकते रहें. और आई वुड congratulate to CA Gaurav Gargji to selecting this special date to start with the Gurukul series. Congratulations Gaurav ji, आप के सानिध्य में हमने पिछली साल भी बहुत कुछ सीखा है, एंड दिस ईयर ऑल्सो यू हैव सेलेक्टेड द वंडरफुल डेट, और आपने अभिजीत मुहूर्त में ही सेशन को चालू करवा रहे हैं. ये भी एक बहुत ही बड़ी अच्छी चीज है. आई वुड कॉन्ग्रेचुलेट ऑल द पार्टिसिपेंट एंड आई विल give you best of luck for this wonderful session. Without taking much time, thank you from my side. Thank you very much, sir.
Thank you गौरव भाई. But just to clarify, मैं कभी भी कोई चीज सिलेक्ट नहीं करता, वो भगवान राम अपने आप मुझे दे देते हैं कि इसी दिन करना था. आई थिंक इट्स मेयर चांस ऑफ लक और कोइंसिडेंस कह लीजिए. थैंक यू. नाउ ओवर टू द सेक्रेटरी NIRC सी नव्या मल्होत्रा जी.
बहुत बहुत नमस्कार आप सबको, और मैं तहे दिल से धन्यवाद करना चाहता हूं हमारे चेयरमैन का, जिसने एक विजन रखी, जिसने विजन रखी कि हम कुछ ऐसा करके दिखाएं जो सबसे हटके हो. और गुरुकुल सीरीज जब रखी गई तो मैं कहूँगा नन अदर देन गौरव गर्ग जी, जो हम सबके गुरु हैं इस टाइम, उन्होंने ही गुरुकुल का आज इंसेप्शन स्टार्ट किया है. तो मैं धन्यवाद करता हूँ गौरव जी का, जिन्होंने बीइंग आफ्टर चेयरमैन ऑल्सो, he is leaving no stone unturned in making NIRC the best NIRC ever. Thank you Gaurav ji. And to Jimmy ji, my branch chairman, Kaushal ji, and none other than our favorite Gaurav Agarwal ji, who is always and always they are keen to do for anything for NIRC. The speaker, the Nikasa chairman Jagjit ji, and all the speakers who are yet to come in the series tomorrow and day after tomorrow. आई बिलीव गौरव जी, जैसे बूट कैंप आपने शुरू किया था, हम उसको अब और आगे ले जाने के लिए, लीगेसी कैरी फॉरवर्ड करने के लिए कोशिश कर रहे हैं और प्रयत्न कर रहे हैं. और जो चेयरमैन है वो, मैं फिर से बोलूंगा कि उनके लेफ्ट और राइट में इतनी सारी सीरीज लिखी हुई हैं, जिसमें से आज एक और सीरीज का इंसेप्शन हो रहा है. तो अगेन a round of applause for our chairman, who is doing day and night 24 hours work for NIRC. Thank you chairman for all your leadership and guidance. Thank you Gaurav ji.
Thank you Navya bhai. It is good, you feel good that whatever you have worked, it is not going to waste. There are people, there are friends who are taking it forward and doing better and improving. I think that's what you call a growth. So now it's a time to hear my dear friend, younger brother, and present chairman of the Northern India Regional Council, under whose leadership we are all working day and night. Avira bhai, over to you.
Thank you, Gaurav-ji. Very warm welcome and good evening to all the members. Our immediate past chairman, Gaurav Garg-ji, our Badinda chairman, Jimmy Bhai, my secretary, my treasurer, Navya ji, Gaurav Agarwal ji, Jaggeet ji, and my moderator, Kaushal Bhai, and learning speaker, our today's session, CA Saurav Bhattacharya ji, and our all esteemed members who are joining this program virtually. I want to welcome all of you in this first series of Gurukul. काफी अच्छा लगता है जब हम एज अ टीम काम करते हैं, तो उसका जो आउटपुट आता है वो बहुत ही अच्छा आता है। तो मैं सबसे पहले तो धन्यवाद करना चाहूंगा अपने टीम मेंबर्स का, जो मेरे साथ कंधे से कंधा मिला के इन सीरीज को सक्सेसफुल करने के लिए दिन रात मेहनत कर रहे हैं। और हम ऐसे ही आगे मेंबर्स के बेनिफिट के लिए काफी सारे प्रोग्राम्स और काफी सारी चीजें करते रहें। इस साल हमने ये नया 8 सीरीज स्टार्ट करी है, डिफरेंट डिफरेंट, जो आपके पीछे मेरे लोगोज में दिख भी रही होंगी। तो अभी सबसे पहले हमने शक्ति स्टार्ट करी थी, शक्ति वुमेन्स डे पे था वो पर्टिकुलरली। उसमें स्पीकर्स और मेंबर्स हमारी मैक्सिमम वुमेन्स ही रहती हैं। उसके बाद संपूर्ण स्टार्ट करी, टैग टैग स्टार्ट करी, और आज हमारी 4th सीरीज स्टार्ट हो रही है, गुरुकुल। इसमें सेशंस है हमारे आज कल और परसों, टाइम सेम है सबके, 4 to 6 डिफरेंट डिफरेंट स्पीकर्स आ रहे हैं। आप लोग इसमें वर्चुअली ज्वाइन करके अपने काफी सारे बेसिक आइडियाज और जो डिफरेंट चेंजेस हो रहे हैं डे टू डे बेसिस पे, वो स्पीकर से क्वेश्चन करके और समझ सकते हैं। इसके अलावा हमने इस वाली सीरीज में डिफरेंट ब्रांचेस के चेयरमैन को इन्वॉल्व करने का हमने एक नया स्टेप लिया है। ऑडिटर हमने जो यंग हमारे चार्टर्ड अकाउंटेंट्स हैं उनको इस एक प्रोजेक्ट में, और आप ये कह सकते हैं नई सीरीज में स्टार्ट करें, ताकि वो डिफरेंट स्पीकर्स डेवलप हो इन फ्यूचर। और इन फ्यूचर ये कौशल भाई का भी हमारा एक्सपीरियंस टैक्सेशन का, ये भी फ्यूचर में एज हमें किसी टॉपिक पे गाइड करेंगे। तो एक कंप्रिहेंसिव पैकेज बनाया है हमने, जिसमें डिफरेंट चेयरमैन अपनी ब्रांचेस में भी इन प्रोग्राम्स को इंट्रोड्यूस कर रहे हैं, और इन फ्यूचर में वो अपनी ब्रांचेस में भी इस तरीके के प्रोग्राम लॉन्च करेंगे। तो आप सब मेंबर्स को मेरे ये रिक्वेस्ट है, मैक्सिमम नंबर्स में आप ज्वाइन करें, इस प्रोग्राम का बेनिफिट लें। और इन फ्यूचर कोई भी आपके अपडेट्स हैं, कोई भी इनपुट्स हैं, कोई डिफरेंट टॉपिक्स का प्रोग्राम करना चाहते हैं, तो प्लीज लेट मी नो, और लेट अस नो थ्रू अवर टीम आल्सो। और हम इन फ्यूचर इन सारे स्टेप्स को और टेक फॉरवर्ड करेंगे, और काफी अच्छा। थैंक यू।
Thank you, Abhinav bhai. Once again, thanks a ton to the complete NIRC team, including Chairman NIRC, Secretary NIRC, Treasurer NIRC, Mikasa Chairman, and Kaushal ji Moderator, Jimmy ji Coordinator, and Saurabh ji as a speaker. So today we would be covering some of the key issues which are there in the international tax, more specifically in the non-resident taxation. And we have none other than Saurabh Bhattacharya ji, who has got mammoth experience and currently working as an associate partner of PwC, who would be guiding us. Tomorrow, we would be discussing the inflow of investments in India. That is, the investment by foreign companies in Indian companies. What are the tax issues relating to them? If there is any opportunity for the structuring. What about the angel tax? There's recent changes happened in the angel tax, so the same would be covered tomorrow. And tomorrow we will have Gaurav Singhal with us, who would be discussing that topic. He is having around 20 years of experience in non-resident taxation. Day after tomorrow, that is on the Friday, which is 19th, we would be taking up key issues in transfer pricing. And to discuss that transfer pricing topic, we'll have C. Nitin Narangji with us. Again, Nitin has got more than 20 years of exposure in transfer pricing. He's currently working with Nagi and Company as a partner. So he would be joining us on Friday. So I request all the attendees who are there today, kindly spread the word, because you would get update about what are the key issues from the people who are actually leading in this service lines. So now, without taking much time, I think we have reached 150 plus attendees, and it's a good time to hand over the stage to our speaker for the session, CA Saurabh Bhattacharya ji. And if any of the audience has any question on the topic, I would request kindly raise your hand. Wait for your turn. You may put questions in the Q&A box. Wait for your turn, and at the appropriate time, our moderator, C. Kaushal Sharma ji, would be taking up the questions. Thank you. Over to Saurabh Bhattacharya ji.
Yeah, thanks to Gaurav, my friend, and all the office bearers for giving me this opportunity to talk in this August platform that has been built up over the years. And thanks to the work of Gaurav and other similarly placed chairman, office bearers. So I'll start with a small presentation that I have tried to make in order to bring forward to you the things which I considered the key aspects of international tax today. Actually, there are many aspects of international tax. Out of that, I have selected five only. And even then, five out of even in that five, I don't know to what extent I will be able to do justice to all of them. But well, I mean, it's worth a try. So I'll start my screen sharing. Gaurav, is it possible that I send the presentation to somebody and then the presentation happens over there? I can only speak.
Sure, sure. Kaushal will do the same. If you have my number, you can WhatsApp me, or should I? You have my email ID, sir?
Uh, no, I don't have email ID. I have the NIRC email ID.
See, I'm texting you my email ID on the Zoom.
Okay.
So you can see on the screen my email ID.
Okay. I think I will be able to present just a minute.
You can go to share screen, and from share screen, you can do it.
Yeah, it is coming.
Now, yes, it is very much
Yeah,
visible.
it is.
Yeah.
Yeah. So the topic for today is key issues in international taxation. And as I started off, selected five issues out of these because issues galore and in whatever time it could be done. The first issue is significant economic presence. The other topics are secondment issues, beneficial ownership, principal purposes test, and the most favored nation. Let's start with significant economic presence. The background to significant economic presence is the principle followed in market oriented economies like India, like maybe Africa also, and countries like maybe China, where there is the population and the market size is big, and that is giving opportunity to big businesses to increase their business. So a philosophy followed by these countries, namely countries like India, etc., is that the profit that big businesses are making are attributable not only to the business head and brain who may be sitting in the other countries, but also to the market which is there in India, which is there in China, which is there in Africa. So the profit from that business should also accrue to the market economies, which is India. And to give effect to that philosophy, a new provision was introduced around 2018, perhaps 2018, 2019, which is called significant economic presence. Uh, and parallel to this is the pillar one, on which I am not going to talk because pillar one, pillar two, those are topics by themselves. And since the law has not come, but only fragments of that law have come in terms of these provisions like significant economic presence, equalization levy, etc. I'll take up the topic of significant economic presence. This provision tells that the significant economic presence of a non-resident in India will constitute a business connection in India. And what is meaning of significant economic presence? It means any transaction where the value of the transaction during a financial year is exceeding 2 crore, or the number of users is 3 lakhs. So, what is number of users? That is also given over here: systematic and continuous soliciting of business activities or engaging in interaction with such number of users in India as may be prescribed. Number of users is 3 lakhs. Now, what is exactly meaning of users? That is not given. That is, of course, given in other contexts. So I have not used that definition. But this is the indication which has been given in one of the rules which follows this law. And significant economic presence comes into existence merely by the volume of sales into India exceeding 2 crores. Nothing other than that is required. It does not require any agreement to be entered into in India, does not require the non-resident to have any residence or place of business in India, and the non-resident need not render the service in India. Just the fact that he has been able to bill more than 2 crore during a financial year is sufficient to build up a business connection in India. And once that business connection happens, is established, there will be taxation. That is covered in the next slide. Now, if this SEP exists, that is, if the significant economic presence is built up, then what will happen? A series of consequences will follow. So much of the income as is attributable to transactions or activities referred to shall be deemed to accrue or arise in India. What is meaning of income attributable to transaction? That I'll come to later. The other consequence is that income from advertising targeting a customer in India will be deemed to accrue or arise in India. Income from sale of data collected from a person who resides in India shall be deemed to accrue or arise in India. And income from sale of goods or service using data collected from a person who resides in India will be deemed to accrue or arise in India. And a person residing in India will include customers who are accessing the advertisement, that is, the advertisement run by the foreign company, who is the seller, accessing the advertisement from an Indian IP address. So even that person will be considered to be a person who is a customer in India or person who is residing in India. So the SEP coming into existence has got this very major consequences, 4 bullet items that are pointed out on the screen. There are various questions in SEP. The first question is, and for that perhaps I should just refer back to the definition of SEP, which is this. Significant economic presence for this purpose and mean transaction in respect of any goods, services or property carried out by a non-resident with any person in India, including provisions of download of data or software in India, if the aggregate of payments arising from such transactions during the previous year exceeds such amount as may be prescribed, which is 2 crores. So transaction in respect of any good, service or property. Coming back to the question, the problem questions, if I can say that way. Income from rendering of a service by non-resident to resident, it is already taxable as a fee for technical services in most of the cases, unless it is not even a managerial, not even a consulting, not even a technical service. Most of the services are in fact like that. So all those services get taxed under the respective provisions, which is fee for technical services. But in spite of having that specific provision, SEP tells that income from rendering service where there is an SEP will be taxed as an SEP income. Similarly, income from sale of property. For example, consider a non-resident having shareholding of an Indian company, and he sells that shareholding to a resident. Now, will it be taxable as a SEP or as capital gain? Because normally shares of an Indian company sold by a non-resident to whoever gives rise to a capital gain, and that is taxable under a separate section. But this is a common ground with SEP, it seems. Similarly, income, if you consider it as a royalty income from download of data or software by non-resident to resident, will it be taxable under SEP or royalty? So common grounds is a problem area in this definition according to me. Now, if they are taxable as SEP, will they be taxable as according to an attribution formula, or there will be a gross taxation prevalent for royalty and FTS? Like suppose there is a royalty income. The revenue generally was considering all payments for software as royalty. And suppose some Indian is making payment for software services, that is royalty to the parent company, to the company, to the foreign supplier, ordinarily that would be taxable at a gross basis. Now, since there is a common ground with SEP, can it now be said that no, stop taxing it at gross basis? Let me do an attribution, let me do an exercise, and then only out of that attribution you will charge at a higher rate, maybe, but the attribution will be important. Whether that will be required. Now, after that comes the question, how much is to be attributed, how to work out that attribution. I mean, to say that so much of the income as is attributable will be taxable to the SEP is not sufficient unless there is clear guidance on how much will be attributed. It is easy to say that business connection and therefore income will be taxable, and so much of the income as is attributable that will be taxable. That is fine, but that's a very general statement. In my view, it does not give any guidance whatsoever on what is attributable. And then the other provisions in SEP, like advertising revenue targeting an Indian customer, and then sales generated based on data collected from Indian customers, these are data points which in my view are extremely difficult to identify. So these are the aspects of SEP which are there at a conceptual and theoretical level. Now let's come to some of the practical problems with this provision. Return filing, return of income filing by foreign suppliers. We can examine this under two situations where there is a treaty benefit which is not available. Suppose the supplier is coming from a country like Chile. Chile is a South American country which has no double tax avoidance agreement with India. And these questions will come up more because, for example, India is now concentrating on semiconductor chip manufacturing, other electronics manufacturing, where copper is an essential ingredient. Chile is a major supplier of copper to the world, and suppose you have many Chilean suppliers supplying to India. In the absence of a treaty, they will all be generating SEP, because I don't think anybody will supply less than 2 crore worth of goods to India. So they will all be constituting SEP. And if treaty benefit is not available, they will all be taxable in India as a SEP to whatever extent it is attributed. The problem is where there is treaty benefit available. Suppose it is coming from a country with which India has treaty, or for that matter, tomorrow, suppose India and Chile enter into an agreement, double tax avoidance agreement, then what will happen? There is a question in the return of income for companies where you have to answer whether you have a do you have an SEP in India, and therefore is it taxable under SEP? Now, if you answer yes in that, that is one aspect. If you answer no in that, can you answer no? That's the question. I was thinking, why should I not be able to answer no? Because whether I answer yes or no will be based upon consideration of the entire gamut of law. And the gamut of law is not only the SEP section, but also 90 subsection 2, which gives me access to the treaty and apply the treaty or act whichever is more beneficial. Now, suppose I am reasonably confident that my treaty will be to my benefit, and then applying the treaty, can I say that, well, there may be SEP, but I have a treaty available, and according to that treaty, I don't have a permanent establishment, and therefore nothing will be taxable. So, um, permanent establishment takes the place of SEP, and therefore I answer no. Is that possible? Well, those are the questions that very practically impacts a person, a foreign company who is supplying goods or providing service to India. The added problem is that my yes or no answer can have other ramifications. Suppose I answer no because I believe that treaty will be taking the beneficial place and a permanent establishment will be there, which will not be there, and therefore there will be no taxability. And on that basis, I answer no. And suppose it is established through a judicial process that no, I should have answered yes, then does it amount to making a false statement in the verification? And that invites prosecution under section 277. So, what is the right thing to do? So, in my humble view, these are the major problems with ACP, and unless these are cleared very, very uh, in a proper authoritative way, these will be a hotbed for litigation. So, this that brings me to a close of the ACP issue. We'll take up the next issue, which is secondment. Now, before that, if we have any questions on ACP, perhaps we could try and answer some of them.
Sure, sir.
Gaurav?
So let me see if any attendee has got any question. If you have any question on significant economic presence, to summarize, what Saurabh said, that even if there is no fixed place of business in India, it's just a trading transaction with India, one could have the taxability in India because of the significant economic presence. Uh, so does it mean that, when you have got a lot of transactions, Saurabh, let's say when I'm dealing with the exporters, when the foreign non-residents are exporting me goods at that time, so should we take some tax residency certificate, Form 10F in almost all the cases, so that we may give them the treaty benefit wherever the treaty is there? And
Yeah,
where treaty is not there, sir, so you said there is an issue that
yes,
what should be the income that should be attributed to India.
yes,
But
yes,
let's say when that mechanism is not available, or that mechanism is available, but being I am not the final concluding authority, I cannot compute the tax. So at what
right,
rate one should deduct a TDS? At the rate of
yes.
40%?
Yes, that's a very practical issue. I mean, consider a supply of goods that has taken place from Chile with which there is no treaty and there is a major payout. At what rate I do I deduct tax? One is that there is no attribution mechanism available. And number two, uh, who determines the rate? Then should I go for every transaction? Should I go to the assessing officer under a 195(2) application that I am making a payment to a non-treaty country? Please determine the tax. And
Hmm.
then why to determine the tax? The only thing is that he has supplied goods more than 2 crores. That's the only trigger of taxation. So those are the practical issues arising from the law.
Hmm. So, sir, we have one question from Manish Agarwal ji, that there is a concept of virtual PE also, I think, in the recent method of Clifford Chance. So, how it is different from SCP? Briefly, I know this is not the topic, but if briefly you can touch upon the same, if it is possible.
ACP actually is not going into the question of whether you have a PE or not. It
Hmm.
is just telling that how much you have sold goods, how much goods you have sold, or how much services you have rendered to India. Moment it crosses the threshold, you are liable to tax in India. So whether you have a real PE or virtual PE or no PE, it's not going into that direction at all.
Hmm. Okay, thank you, sir. Now I think we can proceed for the second issue, secondment issue.
Yeah.
Over to you, sir. Yeah.
Um, Secondment issues, as you are well aware, most of the foreign companies, when they have a, uh, most of the foreign companies, when they have a subsidiary in India or a group company in India set up to do business, they feel that the group company in India, which is a new one, will require guidance if it is a new one. If it is an established company which the foreign company has taken over, etc., even then, in order that the old company's employees will be picking up the culture, the method of working of the foreign parent group, there is need for hand holding, and they send people, experienced staff, to be in India, to be associated with the Indian working, themselves get sort of experienced in India atmosphere, India working, and to guide the Indian employees to be in line with the culture, the way of working, etc., the ethos, etc., of the foreign parent. So that's the concept of secondment. They send employees to India. So there is a foreign hold. The typical structure is this: that there is a foreign hold co or regional management co. Regional management co means the hold co itself is not sending. Hold co perhaps is in the US, and regional management co may be in Singapore, maybe Hong Kong, etc., or Netherlands. They send, and then there is an Indian subsidiary or a group company. Employees for key posts in Indian companies sent from abroad. Indian company generally issues employment letters to those employees who are coming from abroad, and the foreign company issues to them secondment letters telling that you are now deputed to India company for 3 years, and after that you may come back, you may choose to come back, and you may otherwise also take any other decision. But generally, that is the sort of language that is used. Salary locally paid by Indian company, and part of salary is remitted to the foreign company for payment in that country. That's what is generally seen on an average. The questions that arise from such an arrangement is: do the employees sent from abroad constitute PE of the foreign company in India? And salary of such employees paid by Indian company, does it constitute fee for technical services? Uh, Question is, why do they constitute PE of the foreign company in India? Uh, Consider the definition of PE broadly in terms of the decision in Andhra Pradesh High Court in Visakhapatnam Port Trust. What is a PE? PE is nothing but a projection of a foreign company in the shores of another country. So projection of a foreign company in India is a P of that foreign company in India, and the projection is taking place by way of the foreign company sending its employees to India, because company act through employees only. So employees coming to India, setting their foot on India, that is the projection. So there could be a P through them, and it could be a service P because they are rendering service, or it could be a fixed place P because the Indian company has got arrangement which provides to them place at their disposal, etc. So there could be a fixed place P also. So these are the alternatives, possibilities that come to the mind. Second is the salary of such companies paid of such employees paid by the Indian company. Does it constitute fee for technical services? Now, I started the discussion with the premise that the foreign employees come in order to handhold, in order to provide guidance, etc. So, in a way, it's the foreign company providing service, maybe providing handholding service to the Indian company on how to run the business, how to follow procedures, etc. So, and the payment is in the form of the Indian company may not be paying anything to the foreign company itself, but taking care of the employees of those employees of the foreign company in terms of providing them salary, other benefits, etc. Whether that is in the form of could be said to be of the nature of fee for the foreign company sending employees to India. Now, this was a simmering issue. It has been there right from the day perhaps secondments happened. I remember in the late 90s also, this was a case in HCL Infosystem, where HP was then the JV partner with HCL, and HP had sent representative personnel to be on the roles of HCL. And then this question arose that HCL is paying the salary of that person. So HCL is actually paying fee for technical services to the HP company. So that was one. Though the PE issue perhaps was not there that time, but still, I mean, it was a lingering issue right from the day the secondment thing started. And it has continued since then. The latest in the series of litigation is a very recent case of Northern Operating Systems, which, though was in the context of service tax, potentially have ramifications for Indian income tax also. Let's see the facts of this case. Northern Operating System India entered into agreements with foreign group company to provide general back office support to foreign group companies. So here the Indian company decided to enter into an agreement with its foreign group company that I will provide the general back office support to the group companies. Now, foreign group companies thought that uh, the Indian company may not be able to provide good service on its own, so they sent employees to assist Northern Operating System India in this contract. And the Northern Operating System exercised control over the seconded employees, and employees were on the payroll of the group company for social security, retirement, and health benefit purpose. But for all other practical purposes, NOS was the employer. And foreign group companies paid remuneration to the seconded employees and claimed reimbursement from the Indian company. So you can understand there is a foreign company out there. There is the Indian company. Foreign company has seconded its employees to India. The employees remained on the payroll of the foreign company for limited purpose of social security, retirement, and health benefits. But when they were in India, they were basically employees of the Indian company because they were responsible to the Indian company. Indian company would do their assessment for their performance, and the hallmark of an employer-employee relation, that is, the employer will be able to control the outputs of the employee as well as see the manner in which the output was being produced. Both these things would be controlled by the employer. That's the hallmark of employer-employee relationship that was there between the Indian company and the seconded employees. But fact remained that there was another uh, employment relation with the foreign company, which was till the time they were in India. That employment relation took care of social security, retirement, and health benefits. Now, under these situations, the Supreme Court noted that the foreign employees, retained their lien with foreign group companies and did not become employees of NOS. So they made this important observation. The employees were more comfortable with the employment of foreign group companies and therefore they retained their lien. Otherwise, they could have said that, well, I am getting a chance to go to India. I hereby resign with you and I'm taking up a new employment with India. That they did not do. They were more comfortable with retaining their employment with the foreign company. And the terms of employment, even during secondment, are in accordance with the policy of the foreign group companies. This was also an important observation that when they came to India, it was not that Indian company told them that, well, your CV says that you were employees of that company. That's fine, your experience is good, but our salary, our structures, etc., are different from that. So we will be giving salary according to the Indian standards. That's what did not happen. The terms of employment during secondment were in accordance with the policy of the foreign group company. So Supreme Court held that the NOS, that is the Indian company, was service recipient for the service of manpower recruitment and supply, which was being provided by the foreign group companies, and NOS was liable to discharge service tax liability on receipt of such service. So this was a service tax decision. In our view, it has this decision, though in the context of service tax, has income tax fallout, and the history is like this. In Centrica India's offshore private limited, the 2014 Delhi High Court case, it was held that payments under a secondment contract are of the nature of FTS FIS, that is fee for technical service or fee for included service, under the UK and the Canada double tax avoidance agreements. Centrica was also held that it leads to service pay in India. In that judgment, it was held that Centrica is having service pay in India. Now, NOS ruling is indirectly or by implication supporting this view. They are telling that they are employees of the foreign company. If they are employees of the foreign company, then by implication they may lead to establishment of the P of the foreign company in India that is being established. Even prior to Centrica in Morgan Stanley, that celebrated Supreme Court judgment, it was held that deputed employees are not the employees of the Indian company, and the entity which is responsible for the work of the seconded employees is the employer. That is the decisive test that was held in Morgan Stanley. But NOA's ruling has held that such test is not determinative. Thus, to that extent, there is a variation with Morgan Stanley ruling. So, all in all, the income tax effect of secondment agreement remains extremely sort of volatile. And by no stretch of imagination can it be said that a determinative test has been laid down once and for all, that secondment does not create a P or does not involve making payment of royalty and FTS. So secondment issue, in my humble view, was another very critical aspect of international taxation. So this concludes my second point, and as in the previous case, I would invite any comments or suggestions or queries.
So, sir, there is one question from one of our attendee, Paki Agarwal. In your example, you were saying that if the foreign company is sending the personnel to the India, and suppose the Indian company has issued employment letter to those employees, so would their salary be considered as FTS in that case?
In this case also there was employment letter,
Okay.
but Supreme Court said that documents and as well as what you use and nomenclature in those documents, etc., that is one aspect, but I will see the nature of the transaction, nature of the arrangement. What is that nature? They are retaining their employment with the parent company. They are not telling that I am leaving everything and coming and joining in. It's not that. They are retaining their employment. So basically, they continue to remain employees of that company in spite of getting employment letters from the Indian company.
So there, the principle is that if the Indian company is successful to retain the employee, then they would establish a employer-employee relationship. In that case, then we can conclude it is a it would be taxable as the salary. If it is not established that the retaining of employees is not possible, or is there any modus operandi the foreign companies making? So in that case, it would be considered as FTS.
I think this is a problem from which it is virtually impossible to come out. Like, I mean, whenever a foreign company sends its employees to India, uh, it is unthinkable that they will tell the foreign employee that you sever all your relationship with me here and you become a fresh employee of that company. Your relationship with the foreign company is over. That never happens. They
Okay.
always maintain a live link with their employment in the foreign country, simultaneously take up employment in India. Now that former employment, that was considered as determinative in telling that they are really the employees of the foreign company sitting in India, not that they are employees of the Indian company only. So that former employment, that was considered to be a index for telling that they are in India and whatever India company is paying is actually fee for services.
Okay,
So
sir. So
we'll go to the next topic.
yes, sir. Yeah, we can move forward.
Okay. Beneficial ownership. This is I mean, extremely sensitive thing. It's extremely sensitive aspect in terms of treaty benefit, and with the opening up of the law in terms of general anti-avoidance, treaty benefit, principal purpose test, and for that matter, a host of other things Governance issue also included. Beneficial ownership is something which is a very critical aspect of international taxation. Let me read out a few typical treaty clauses. I'm reading out from the Indian Mauritius dividend article. However, such dividends may also be taxed in the contracting state of which the company paying the dividends is a resident and according to the laws of that state. But if the recipient is the beneficial owner of the dividends, the tax for charged shall not exceed this 5% or for that matter, whatever. Similarly, I'm reading from the India US royalty article. However, such royalties and fees for included services may also be taxed in the contracting state in which they arise and according to the laws of that state. But if the beneficial owner of the royalties or fees for included service is a resident of the other contracting state, the tax or charge shall not exceed 15%. The US treaty again under Article 11 interest article tells, however, such interest may also be taxed in the contracting state in which it arises and according to the laws of that state. But if the beneficial owner of the interest is a resident of the other contracting state, the tax or charge shall not exceed 10%. Now, these rates, as you will note, are lower than the domestic tax law rate. Means if you are paying dividend to a foreign company, the rate perhaps is what 20% maybe. If you are paying royalty and FTS fee for included service, under the domestic law, if you are paying to a non-resident, the rate is 20%. Similarly, the rate of interest is also higher than 10%. I think it's also 20%. So treaty benefit will be available only if you are the beneficial owners of these incomes. So what is beneficial ownership? So you can well understand the criticality of the beneficial ownership of these incomes. Treaty benefit will not be available if you are not the beneficial owner. So beneficial ownership is an essential condition for availing treaty benefit as explicitly mentioned in the article concerning dividend, interest and royalties and fees for included service. Now why this explicitly mentioned thing is coming will be clear in subsequent slides. Beneficial ownership is an anti-abuse mechanism. It prevents a person who is not the real income owner from availing treaty benefits by setting up a front in a country with a favorable treaty. How this may happen, for example, is that perhaps the royalty owner, which is the IP owner, perhaps he is a resident of some other country with which India does not have a proper treaty. Suppose he is staying in Bermuda. And then he tells that, well, if I am providing the service, providing the technology behind the service, and India was to pay me a fee for technical service to Bermuda, there would be a 20% and more than 20% tax deduction under the Indian domestic law. So what I will do is I will create a company in US and provide service from that company so that they get the benefit of the India US tax treaty. So he sets up a company in US and starts providing service from there so that he can get the benefit of the 15% withholding. That is to prevent that, it's an anti-abuse mechanism. Generally, an entity which is an agent, conduit, or nominee of the real owner is not considered beneficial owner. If such an entity earns the income will not be eligible for treaty benefit. The same thing, the front company in US that I was telling, he is not the real owner. He is at best an agent, or you could say a conduit, because the FTS will go to him and then it will be passed on to the real owner in Bermuda. Or he could be said to be a nominee. Of course, all these terms have got their legal significance, but for the sake of treaty, maybe you can well understand what the treaty is trying to mean. Now, and these terms, agent, conduit, or nominee, are generally OECD terminology, OECD commentary terminology, but one can well understand what they're trying to hint at. Now, whether an agent is an entity is an agent, nominee, or conduit is a question that may be answered after strenuous examination of facts and circumstances. And generally, the recipient is not considered beneficial owner if it is under contractual obligation to pass over the income to another entity. Now, I give a loan to India, and India pays me interest. The treaty with my country, between India and my country, is not good enough. It provides for 20% rate of interest, rate of tax, etc. In order to prevent that, I open an entity in Cyprus, which has got a good interest article with India, and India deducts at lower withholding. So but that company with that I have opened in Cyprus, I have it has there is a contractual obligation to tell that whenever you get interest from India, pass that on to me. So that's not a beneficial owner because it is contractually obliged to pay over that interest to the real owner of the interest income. So there it will not be considered as a beneficial owner. Now, these stories, as you hear, you can well understand that to establish whether it is a real and beneficial owner is extremely fact specific, very, very fact specific. You have to go to so many lifting the veil sort of thing to understand who is the real owner behind the transaction. And it's easier said than done. It to establish it, either for the revenue to establish that he is not the beneficial owner, or if such an allegation is made, for the assessee to establish that he is the beneficial owner is not by any means easy, as you will see from some of the case laws that I have tried to give as illustration. Two Dutch companies incurred interest expense on some intercompany loans upon restructuring of group entities. Interest expense means they were supposed to pay interest expense on some intercompany loans, and which uh, happened due to this restructuring of group entities. The interest was not offered for tax, assuming availability of treaty benefit. Same thing. I mean, suppose some company was established in a country with which there is a good treaty, and it was not offered to tax. The Danish tax authority, Danish tax assessing officer, held that the interest recipient was not the beneficial owner and thus was not entitled to take the benefit of the treaty. Issue before the court was whether the recipients were the beneficial owner and thus eligible for exemption from tax on interest under the Nordic tax treaty and Luxembourg tax treaty. That is Nordic and Denmark and Luxembourg Denmark tax treaty. High Court of Eastern Denmark observed that the main purpose of the restructuring was to obtain tax exemption for interest that would have been taxable but for the restructuring, and the recipient of interest had no right of disposal of the interest income, and thus the benefit of the Luxembourg or Nordic tax treaty was not available. So you will appreciate the sheer difficulty in coming to this conclusion that the main purpose of restructuring was to obtain tax exemption for the interest that would have been taxable but for the restructuring. This is the crux of it, and I can imagine the enormous effort put in by the Revenues Council and equal amount of effort put in by the Assessees Council to prove the other way around, that it was not the main purpose of the restructuring to establish a front company and get tax-free interest. So the real tug of war that must have preceded this judgment is apparent. So that's why I tell that beneficial ownership question is a question fraught with enormous litigation. This is another example. In India, Mumbai ITAT in this particular judgment held that taxpayer who received interest income for its exclusive benefit and not for the benefit of any other entity would be treated as beneficial owner, and the mere fact that the loan was funded using monies received by taxpayer from its related entity does not affect taxpayer's status as beneficial owner once it is established that the taxpayer had absolute control over funds received from the lender. This is very important because it may be told that you are claiming, as an assessee, you are claiming that you gave the funds to India and earn interest from it, and therefore you are beneficial owner because you gave the funds to India. But I want to go back and see where from you got the funds. You might have got the fund from Mr. X, Mr. Y, Mr. Z, and therefore they are the beneficial owners. Is it possible to tell that? This tribunal judgment is a very good, setting out a very good principle that the lender, if he was in control of the money which he lent, and it is on that money which he got back interest, it is his interest and not the interest to those persons who gave him the money. Because once he has got the money in his own right, the money is under his control, it is his money, and he is getting interest on that money is his interest and not the people who gave him the money. So it is not Mr. X, Mr. Y, Mr. Z's interest, it is my interest. So I am the beneficial owner. This is a very important thing, and it is there is a lot of emphasis to establish that suppose, for example, a Singapore company has lent money to India, and how the Singapore company, or for that matter a Mauritius company, how did it get that money? Perhaps it got it by way of equity funding from its parent company. Perhaps it got it from loan funding by from another bank. Then that fund which reached the Mauritius lender in the first instance, that is the Mauritius lender's money. So Mauritius is the beneficial owner of the interest. Can't be said that since Mauritius parent company gave it an equity funding, therefore the money belongs to that parent entity. That's not the real right way to look at it. So this tribunal judgment is a good authority for that. Of course, it has relied upon other established authority for coming to this principle. There is a question which is often sort of come across. This beneficial ownership term is explicitly used in the treaty in three articles, namely dividend, interest, royalty fee for technical services. In Blackstone Capital Partners, which was decided by Delhi High Court, it was held that the Singapore DTA that time capital gain sorry, uh, these three items, interest, dividend, royalty fee for technical services, those treaty languages, those treaty clauses have got the explicit usage of the term beneficial owner, but this term beneficial owner is not used in capital gain article. None of the treaties you will find that capital gain earned by the beneficial owner of the asset will be taxed, etc. That term beneficial ownership is not used in the treaties for capital gain clause. That was the point of contention in this in this dispute of Blackstone Capital Partners decided by Delhi High Court, where it was held that under the Singapore DTA at that time, capital gain is to be taxed on the basis of legal ownership and not on the basis of beneficial ownership. Concept of beneficial ownership under the Singapore DTA, the court noted, was attracted only qua three transactions: dividend, interest, and royalty. But this case is now before the Supreme Court. Perhaps in April only is the next date. So we are waiting with a very sort of eagerness to see what the Supreme Court decides in this. How, whether the concept of beneficial ownership should be read into the capital gain article as well. And there is a parallel, opposite, and very strong view, of course, which is like this. The counter view is that the concept of beneficial ownership is sometimes considered not relevant for the purpose of benefit under the capital gain article in the treaties because the term beneficial owner is not explicitly mentioned in the article. However, unlike the wordings used in the articles like royalty, etc., the wordings of capital gain article are flexible enough to establish a connection between the gains and the resident of the contracting state. Principle of beneficial ownership is embedded and can be traced in the article relating to capital gains due to usage of the words such as derived by, earned by, gains of the enterprise, alienator, etc. It seems to suggest that it is pinpointing as to the person who really derived. Derived by means really derived by. Earned by means really earned by, not like earned by as a front company. So this is a very strong counter view to the concept of beneficial ownership in a capital gain treaty. So as expected, the strong counter view and the other highly technical view. Of course, I mean, the treaty does not use the term beneficial owner in the context of share, and why it doesn't use. Is there a thought process in the mind of treaty negotiators where they consciously avoided the word use of the word beneficial ownership in the context of capital gain? Is that a meaning, or whereby even a front owner could be given benefit of capital gain article? So that question is, as expected, before the Supreme Court, awaiting a decision any time now, perhaps. So this brings me to the close of the topic of beneficial ownership, and here again would like to invite any comments, suggestions, or queries.
So, as for beneficial owner, we do not have any question, but we have a question relating to the prior issues like secondment issues.
Hmm.
So, there is one of our attendee who asked how to test whether seconded employees are constituting service private PE or a fixed place PE in
Yes.
India.
Hmm, hmm, hmm.
So, how do we test that?
Service P generally defined in the treaty, it is telling that rendering services through employees or other personnel in the other contracting state. Now, is it possible to say, like in that HP HCL case, when HP sent its employee to HP to HCL, is it possible to tell that that employee on reaching India in the office of HCL rendered service, and when the employee is rendering service to HCL, the employee is not rendering any personal service. It is HP rendering service to him, and how to HCL. So how is HCL getting the service? By HP having sent its employee to India to its office, and thereby HP is present in India for rendering service, and that is the typical definition of service P. Hence, it constitutes a service P. We are not uh, considering the aspect of make available, etc. Just plain and simple. That is one. So by that it becomes a service P. On the other hand, and extending this further, it can also be said that when such a high ranking employee of HP was sent to HCL, it is unimaginable that HCL will tell to him that, well, you have come, you have to provide some service, you provide some service anyhow. I cannot make any space available to you, I cannot give anything at your disposal. If you have to render service, come render service and go away. I don't care. That is not possible. He's a high ranking employee. He would tell, I want a cabin, I want a secretariat, I want a team assisting me because I am helping you to run your business. It's a very important person. So he has resources at his disposal, place at his disposal, and for a reasonably long period, not for 1 day or 15 days, at least 6 months perhaps, if not 5 6 years. So more than 6 months in course of a financial year. So he has a place at his disposal, thereby constituting a fixed plus P. That's how it may constitute a fixed plus P also. And that's my understanding of how it can be a fixed plus P or a service P.
Okay, sir, thanks for the answer. There is one question as well from Vipin Jain. Is there any responsibility on the professional to check the actual beneficial ownership before issuing TDS certificate in the Form 15 CB? If yes, and how?
I mean, that's an ideal situation. The professional sees the actual beneficial owner, but it is by no means an easy thing. I mean, what can you do? You cannot do a forensic examination, because if you take up that route, suppose you find that you are paying interest to a Cyprus company. You tell that how Cyprus company is beneficial owner. You show me. You get some links that Cyprus company got the funds from another company. Then you ask for that other company got funds from another company. So you go deep and deep and deep, where you will end up god knows. So who is the beneficial owner, you will be lost in that maze. So whereas that is the ideal way to do, but I think in practice you will always have to practice. It means in the real world, the practical world, you will always have to strike a balance between what is possible and what is doable. So in that, we will have to perhaps put reliance on the certificate from them that this is the beneficial owner, and I have done a reasonable due diligence on that certificate. So that should be fine. At the same time, these the circular 789, which was issued in the context of Mauritius Treaty, told that the income concerned, the beneficial ownership of the income concerned is established as soon as you get a tax residency certificate from that foreign company. So that is the first reliance. And circular 789, which was upheld in Azadi Bachao by Supreme Court also. So TRC or tax residency certificate is the first due diligence that a practicing person will have to get. Coupled with that, Form 10F also now, and maybe whatever professional judgments you think can be reasonably applied, all those should be applied in order to come to a reasonable conclusion that yes, he is indeed the beneficial owner. Beyond that, I don't think it is possible.
Okay, sir. So we can move forward.
Yeah. The next key issue in international taxation is the principal purposes test. Principal purposes test is of a pretty recent origin, whereas all these things, all the other topics except ACP, were ingrained in our international tax practice for long. And ACP also, a precursor to that was the equalization levy, which is talking about market economy getting some tax from the revenue generated by the foreign company. But to that extent, that is also old. But this principal purpose test is of comparatively new origin. It is now a common feature in the double tax agreements, most of them pursuant to the OECD BEPS program. And principal purpose test is an anti-avoidance measure that seeks to deny treaty benefit to a transaction if obtaining treaty benefit is one of the principal purposes of arrangement or transaction, unless obtaining that benefit was within the object and purpose of the relevant provisions of the treaty. You will appreciate that this is something, the purpose is something like beneficial ownership also. They are also a front company. The objective of not giving treaty benefit to a front company by telling that, are you the beneficial owner, only then you will get treaty benefit. The same sort of objective is ought to be subserved by this PPT clause. But well, I mean, it has come in a more sophisticated way, and the tests, etc., are also quite interesting, as I will try to present some. Most of the Indian treaties have got the PPT clause. Prominent treaties that do not have the PPT clause are the India-US DTA. For example, you are well aware that US did not go for this MLI and all multilateral instrument. So India-US does not have it, and India-China DTA also does not have it because China did not consider India as agreement as a covered tax agreement. So India-China does not have. PPT recently proposed for the India-Mauritius DTA. A lot of praise on that. And India-Mauritius DTA, even though India and Mauritius did not consider India as covered tax agreement, but PPT has been incorporated through bilateral mechanism. So that way it is now proposed because it has still not seen the light of the day in terms of official terms of an official declaration. So it's still there, it's in the proposal stage. So this is the genesis of principal purpose test. If we x-ray PPT clause, we'll read it once again because it's typical OECD and international tax language, not very much in accordance with how we are used to reading tax. reading the income tax law. So let us read it once more. PPT is a measure that seeks to deny treaty benefit to a transaction if obtaining treaty benefit was one of the principal purposes of the arrangement or transaction, unless obtaining that benefit was within the object and purpose of the relevant provisions of the treaty. Now, if a certain transaction that I have done with Indian resident gave me the tax benefit in terms of India not being able to tax it, uh, was that particular objective that India will not be able to tax it, was it one of the main purposes of my entering into the transaction? Well, if it was, then I have stepped into the world of principal purpose test. And what can save me? It can only if I can demonstrate that getting that benefit in terms of India not being able to tax it was within the object and purpose of the treaty. Only then I will be able to tell that, well, PPT should not apply to me and I will be able to avoid India taxation as in the past. So coming back to, I call it a X-raying of the provision, as if passing the provision through an X-ray plate. We see that there are two parts in the clause wording. Is one of the main purposes is to obtain treaty benefit? Could be, must be rather. It's impossible to tell that I came from US and not that US was the main supplier of the technology. That's fine, but was it also a fact that some there was a consideration in my mind that the tax rate may be near was US. Was it one of them as the supplier? Well, that's again very much a factual thing. And even if that is the case, is treaty benefit within the object and purpose of the treaty provision? What is the object and purpose? That's a second challenging thing. How will you establish what the object and purpose of the treaty was? You will only have recourse to circumstantial proving and evidencing. Extremely difficult according to me. So we'll see how it has been explained in the OECD examples. So PPT analysis is an exercise to find answer to the aforesaid two questions. As evident, it is a highly factual examination. Let's see some of the examples that OECD has given in its commentary on BEPS to explain principal purpose test. T company, that is a resident of the country T, owns shares of S company, a resident of country S, a company listed on the stock exchange of state S. And there is no DTA between state S and T. Dividend payable to entity of state T is subject to 25% tax because there is no treaty between S and T. So any company of S paying dividend to a holding company of T will subject that dividend to a 25% tax. Now there is another state R with which state S has got a good DTA which provides for nil tax on dividend. So T company, what it does is wants to get that dividend tax free, it assigns that dividend receiving right to a state R resident. If you come across a situation like this, then OECD tells that PPT shall be invoked because it is reasonable to conclude that one of the principal purposes of the arrangement was to obtain treaty benefit. You have just given your dividend receiving right to that company, whereas holding your shares, whereas holding all your shareholders' rights in the state T, just because you want to have it tax free, you have told somebody in R that, well, you get the dividends. I have assigned the dividend getting rights to you. You will not get the treaty benefit because PPT will come in the way. To some extent, this is similar to our clubbing provisions in our domestic law, which tells that assignment of income without assignment of the assets giving rise to that income leads to clubbing in the hands of the person who assigned. It's something like that in this example. Next example. state T company owns shares of state R company, which owns shares of state S company. So you have a structure T as the ultimate parent, then R intermediary parent, and then state S subsidiary. State S and T do not have DTA, but state R and S have favorable DTA. State R company is into electronics manufacturing and state S is into distributing the same in state S, which means R manufactures, exports it to S distributes that. State S company declares the dividend to state R company. Now, will you tell that no, why there was a need for R? Because there was a good treaty you must have entered into your shareholder arrangement between state S and R because you have seen that good treaty and you set up a company in state R to get dividend from S so that you get it tax free. Whereas the main money supplier is state T. You should have shareholding should have been from state T only. Could ask that. Here the OECD's guidance is state R is carrying on real economic activity. State R company is carrying on real economic activity in state R. Absent other facts, it cannot be said that the purpose of having an intermediary holdco in state R was to take state R and S tax treaty benefit. PPT should not be invoked. You just cannot tell that your main parent company is T and therefore all dividends should be going to T after due taxation in S. That you cannot say. Have to take a consideration of the entire surrounding facts and circumstances. R is a well-established business over there. It has invested in S, getting money in the form of dividend from S. Why should you tell that T should get the money? T should not get the money. PPT will fail to bring it under the purview of estate taxation. Some other illustrations. State R is into electronics manufacturing, is considering establishing manufacturing plant in developing countries to benefit from lower manufacturing cost. 3 jurisdictions shortlisted with similar economic and political situations. State S, one of the 3 jurisdictions, has a favorable treaty with State R. It is decided to build the plant in State S. Will you tell that obtaining treaty benefit was the main purpose over here, one of the main purpose over here? Because you had 3 identical countries, China, for example, India, for example, Vietnam, for example, they all 3 were vying with each other who will get investment from, say, Apple. I mean, just as an example. Apple decided that, well, my US India treaty is not so good. US Vietnam treaty is good. Let me go to Vietnam. All things remaining the same, there is a better treaty in Vietnam. Should it be exposed to tax in other states in Vietnam by telling that no, you came to Vietnam only looking at that treaty and therefore I will apply PPT? Can it be said like that? Here, OECD's guidance is general objective for tax conventions is to encourage cross-border investment. Obtaining benefits of the state R&S convention for the investment in the plant in state S is in accordance with the object and purpose of the convention. This is a very interesting example. It gives guidance on how to read objects and purpose. It tells that general objective of tax convention is to encourage cross-border investment. All things remaining equal, if state S has got a good treaty, merely if I see that and go to state S, you cannot tell that treaty was my main objective. Main objective was lower manufacturing cost. Treaty was an add-on benefit, and therefore I have gone to state S, which is nothing wrong. So PPT will not come to apply and levy tax in state S. The fourth example, state T owns number of operating subsidiaries across jurisdictions. It sets up a state R company to render accounting, legal, HR, financing, and treasury services to the group operating companies. Decision to set up state R company was driven by availability of skilled manpower, reliable legal system, business-friendly environment, political stability, and business. Okay, I've repeated this in state R, and also availability of comprehensive DTA network. Now, state R has number of operating subsidiaries in various countries. It's typical multinational structure. Many countries, they have their operating subsidiaries. There is also the concept of these regional management companies where they provide accounting and other service, legal service, HR service, etc. to their subsidiaries. So typically, say some regional management company has been set up in Singapore. Why it was set up in Singapore? That is a very relevant consideration, and it is providing service to the respective subsidiaries in other countries. Uh, can it be said that, well, you have set up that regional subsidiary company in a particular state and is getting service revenue in that state only to get treaty benefit? Can it be said like that? Because you are a company of state T by to start with, and you are providing some management services to your group company, you provide them straight. Why have you brought in interposed R? That must be with a I to tax benefit. Here, OECD's guidance is PPT rule not to apply if our company undertakes significant function asset risk for providing services through its own personnel. Now we have to demonstrate that R is not just a conduit. R is actually providing the service by staking its assets, providing significant economic functions, taking significant risks in earning the service revenue, etc. If you can prove that from R's point of view, then you can say that R is real earner of income, and you should not disregard R and tell that T is earning the income and subject it to the source country taxation. So this concludes my analysis of PPT. Again, would invite queries, comments, suggestions, etc.
So anyone in the attendee from the attendee may ask question pertaining to PPT analysis.
I understand questions on this particular topic. I mean, this is still in the realm of we have not seen litigation, etc. So questions to arise in the mind, generally they arise from litigation and all, but then these have not yet seen the lights of litigation. We'll definitely see, and maybe extensively, but not yet.
So I guess,
We can go to the next topic.
yeah, sir, we can.
Most favored nation clause. Most of you, perhaps all of you, have heard of this term and the concept and all, because it took the nation by storm a few weeks back. Uh, what does a most favored nation clause look like? What is the clause? A typical clause I have picked up from the India-Hungary double tax agreement. In respect of Article 10, dividend, interest 11 and 12, royalties for fee and fee for technical service, if under any convention, agreement or protocol between India and a third state. What is the second? What is the first state? First state is India, second state is Hungary, and the third state, India, and that third state, which is a member of OECD. India limits its taxation at source on dividends, interest, royalties, or fees for technical services to a rate lower or a scope more restricted than the rate or scope provided for in this convention on the said items of income. The same rate or scope as provided for in that convention, agreement, or protocol on the said items of income shall also apply under this convention, which means uh, India has an agreement with Hungary, double tax agreement with Hungary. It also has an agreement. It also has an agreement with a third state, which is a member of the OECD. And in that third state agreement, it has limited the scope of taxation in India of interest, dividend, royalty in terms of, say, better rates or in terms of restricted scope, etc. Then what happens? Then this clause tells that if that is the case, then those restricted rate and scope will also apply to the India-Hungary treaty. Now, from which date, in what are the procedures for applying, etc., those are the nuances on which there was litigation. We'll come to that in terms of, giving an indication of that. But this is what a most favored nation clause is actually. So, what are the features of this? It most favored nation clause. It limits taxation under a treaty to the extent of more favorable rate or scope in another treaty. More favorable treaty should be between India and an OECD member country. And in practical terms, India has MFN clause with Sweden, France, Switzerland, Philippines, Belgium, Netherlands, Spain, Hungary, and maybe another country. Not quite sure about that. Essentially, there were two questions of disputes which had made the round so far, considering the litigation history so far. Better to understand it in with an example. India has a DTA with state A containing MFN clause. Subsequently, India enters into a DTA with state B, which DTA provides for more favorable terms of taxation in India in terms of scope and or rate of royalty and fees for technical services. Now, the 2 points of dispute are: must state B be a OECD member on the date on which India's DTA with state A entered into force? And must India extend favorable tax treatment to state A residents similar to state B DTA automatically as state B DTA comes into existence, or should it wait for a separate notification to be passed? These were the 2 points of dispute that historically made the rounds. How was the controversy scenario? Decisions by Delhi High Court in favor of the SSE were these: Concentric Service Netherlands, Deccan Holdings BV, and these Galderma Pharma. These there were, and this the other one, Inspection. These were the favorable decisions where they told that it has to be even perhaps a late entrant in the OECD field could qualify for this for your reference point, and it does not require a separate notification. But there was a circular issued by CBDT in 22 which said that countries should be OECD member from which particular date. The OECD, CBDT tried to provide a guidance on that through that circular. And MFN clause should be applied from which particular date, because all the MFN clauses do not read like that Hungary clause. That Hungary clause I read just for the sake of illustrating how a clause typically reads like, but there are nuances in individual treaties. Separate notification is required, and higher rate would be attracted if the prescribed threshold is not met. Therefore, the CBDT told that these are the conditions which are to be satisfied. If you do not satisfy these conditions, then even with an MFN clause, the higher rate will be levied till the condition is satisfied. And one of the condition is that it should be an OECD member right from the beginning. So if that condition is not satisfied, then it will never be satisfied. Supreme Court has settled this controversy in AO International Tax versus Nestle case, which was decided late in 23. The salient features of the Supreme Court decision: separate notification is required in case of a change in law, notification required in the official gazette to give effect to a DTA or any protocol changing its terms and conditions which has the effect of altering the existing provisions of law. So separate notification it talks about. Applying MFN clause present in one DTA to import benefits from another DTA requires amendment through a separate notification under section 90. So this is a sort of a procedural law laid down by the Supreme Court, that merely telling that if another country's treaty with India, which is of course an OECD member, gives better benefits, then this country's treaty with India will start giving benefit as soon as that treaty comes into existence. That will not happen. It requires a separate notification. Otherwise, the things will not be under the control of the government. That was the argument of the council in that case from the revenue side has also agreed to by the Supreme Court in terms of accepting the proposition that unless there is a separate notification, there is no automatic application of the reference treaty. And the word is has a present signification. It derives meaning from the context. A third country should be an OECD member when it enters into a DTA for an earlier treaty partner to claim MFN. So it cannot be said that the country with which India has entered into an agreement, if that country is a late entrant into the OECD group, then also your treaty will have the same beneficial rate. That cannot be said. It has to be OECD member from the beginning, from your treaty's date at least. So these were the two major questions that were decided by the Supreme Court. Of course, as you are well aware, this MFN thing has again gone back to the Supreme Court for a review. And I do not know whether it's technically called review or some other appeal. I think it's a review petition again, which is in the Supreme Court. So the last word perhaps is yet to be heard, but you never know. So far, the standing law is what is contained in this MFN decision in the Supreme Court. So I think with this, I have been able to cover the five key topics in international taxation that I had in mind. And again, I would invite various comments and suggestions.
Yes, sir. So there are two questions that I have got from the audience relating to PPT. So first is generally many US company invest in India through Mauritius. Does PPT apply in this case?
See, when they invested into India, the Mauritius Treaty had a preamble that the treaty is being entered into for mutual economic benefit. So when India required that investment, they entered into agreement DTA with Mauritius, providing for mutual economic benefit. Then Mauritius will also be benefited. India will be also benefited when there is investment coming from Mauritius. Now the question of through Mauritius was perhaps not explicitly mentioned, but then fact remains that the treaty that time, the general object and purpose of the treaty was to further economic benefit. So taking the benefit of that treaty, if there were investment from Mauritius to India, so be it, even if the supplier of the fund uh, or for that matter, the business stakeholder, real stakeholder was USA. That time, the treaty's language was that for mutual economic benefit, that was necessary. So perhaps it could be argued that the object and purpose was met. So even if there is a treaty benefit, it was within the object and purpose of that treaty, and therefore PPT should not trigger to deny the tax benefit. That's the way I look at it.
And the second question is in the context of a client's hotel booking business, which involves earning commission from transaction outside of India and considering establishing an entity in Dubai for tax saving purposes, how could the principal purpose be invoked? This is the question from Manish Gupta.
It is a hotel booking platform, right?
Correct. Hotel booking business.
Hotel booking business.
Yeah.
So if it is a Dubai entity, it's not a Dubai entity that has set up the entity in Dubai, right? It's some other country's
Is an
business.
entity. Yeah. So establishing an entity in Dubai.
Yeah, so perhaps an Indian has established entity in Dubai and generating revenue from that business and telling that it is a Dubai entity and not liable to India tax. So again, it is a factual analysis. We'll have to see the real head and brain behind that Dubai company. If the head and brain is in Dubai itself, then what is the problem? The Dubai entity is doing business and earning revenue and income in Dubai, so that should not be a PBT problem. But if it is found that the head and brain behind Dubai is India, then of course there could be a issue. Like then it could boil down to other things like how the income stream, of course, will be commission income from travelers all over the world, but that will all get accumulated and taxed perhaps in Dubai. Now, how will India access it? That is a question. On what basis? Even if the shareholder is an Indian company, how will you tell that it uh, uh, is an Indian company? It's not a Dubai company. I think that will be a difficulty in telling that it is really an Indian company. If you apply POEM, place of effective management, there also with the treaty, how will you apply? Unless you apply GAR, perhaps I don't know how India will have access to that company and taxing it.
Okay, so anyone from the audience who would like to ask question on the key issues of today's topic, so they may ask on the topic. Yeah, so there is one question. How are overseas based e-commerce aggregators rendering services are taxed through what mechanism in India?
Um, it could be through equalization levy also. Could be through equalization levy. I think that is the primary way through which they are taxed, because equalization levy have got separate provisions which tells that either advertising revenue it is at 6% or it is other overseas aggregator where those conditionalities are made, then it is taxed at 2% of their revenue. So that is one method of taxing, equalization levy. Otherwise, if they are getting payment from India, if it is royalty, then it is taxable as royalty on a gross basis. That's also another way. But then the two cannot be together. If it is royalty, then it's not equalization levy. That's how it works.
Okay. So do we have any other questions relating to today's topic? So we may ask. Yes, sir. There is another question from uh, Gupta Gulapudi. In connection with Dubai business, if the promoters are from India and those promoters are receiving remuneration from such Dubai-based company, and that Dubai company is taxed over there, then how it will be taxed in the hands of the promoters?
Yeah, if the promoters are getting, say, dividends from Dubai, then it's Indian residents getting dividends from foreign companies. So that is a residence-based tax. It is taxed to the promoter. If the promoters are drawing remuneration from there, maybe as executive directors and all, then that salary income may also be taxed in India. But if the promoters are non-residents, then again to tax them in India will have to be seen on what basis you could tax a non-resident promoter in India. Whether he earned the income in India may not be, because he was executive director of the Dubai company. How could it be said that he earned the remuneration in India? Even if he received it in India, it doesn't matter. So to establish the connection in that case will have to be facts and circumstance driven to see how the Indian resident got money from Dubai, which could be subject to India tax. Otherwise, the primary taxation in this case is the Dubai business only.
Okay. So the next question pertaining to MFN. In light of Supreme Court judgment regarding the most favorite nation clause, how should one proceed with regards to the implementation of this clause in the context of previous transactions?
Mm, See, one should be on the lookout for a notification, like some notification has come out recently. So that notification should be there, because you cannot take for granted that without notification, the MFN clause will automatically start applying, number one. And number two, um, the OECD membership of that country, was it there or was it new? That you come to know as soon as you hear the name of the country. So that is there. Most important is the notification. Unless that is there, to proceed on the basis that there will be automatic application, that is clearly wrong.
Okay. So the other question is on secondment. On secondment, if certain portion is paid as salary in India to the seconded employee and taxed under section 192, can the same amount be taxed again as FTS or FIS?
That's a pertinent question, and in fact, this question was answered by the Delhi High Court in HCL Hewlett Packard case, where they told, and there is a circular of CBDT also, that once an income has been subject to tax and TDS has been done under one provision, it cannot be subject to TDS under another provision. So if you have done it under 192, you cannot do it again under 195. That remains the Delhi High Court decision and the CBDT circular as well. But on principle, the Supreme Court judgment has not gone along that line, because it was a service tax judgment. But it seems to give an impression that you are paying salary, that's fine, but effectively it's a fee itself that you are paying. And more so in that case, the entire salary was remitted outside and then paid by that foreign company to the Indian employees. So there it was easier for the Supreme Court to tell that you have paid service fee to the foreign company. Whether Supreme Court would have taken the same view, if it was shown that the Indian company paid salary direct to the foreign employees who were working in India, whether Supreme Court would have taken the same view is anybody's guess. So that, of course, there is a chance to contend on that line as well.
Okay, so do we have more question on the today's topic, or else we can call it a day? So anyone may ask question. So I guess everyone has got their answers, and so thank you, sir, for taking time out for today's session. And I think you have wonderfully explained all the key issues of international taxation pertaining to whether it is significant economic presence, secondment issues, beneficial ownership, principal purpose test, and last but not the least is most favored nation. So that is wonderful session for us, and you made us understand all the aspects of the key issues. Even you have discussed some practical and the judiciary pronouncement as well, so that we can understand it more precisely. So thank you very much, sir, for the wonderful session.
I also take this opportunity again to thank you and the other office bearers for giving this opportunity to work, to talk on this August platform, and how much I have been able to make people understand that I will not comment on that, because it's very, very involved and question, very, very legal at times, legal, factual, mixed. So quite a vast area to be in.
But sir, the examples that you have given to us is wonderful, and I guess everybody understood very nicely. So it's good. So now, yeah, I would like to give the certificate, and I would like to invite an IRC who will share the certificate to CA Saurabh Bhattacharya ji for giving the great speech on the topic of the today. Thank you for your time.
Thank you. Thank you.
Yeah. So,
I would also like to present a certificate to CA Kaushal Sharma ji.
yeah. Please share. So it is not visible.
Yeah, yes, sir, just sharing.
Yeah.
Yes, sir.
So thank you
Kaushal
very
sir?
much for,
Yes.
yeah, thank you, sir. So
Thank you.
Yeah, so we can end today's session. So thank you, sir.
Thank you. Thank you.
Okay.
Thank you all of you.